You're about to join Niels Kostrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Alan Dunne and I, Niels Kostrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Alan, wonderful to be back with you this week. How are you doing? How is Dublin treating you?
I'm good, Niels. Good to be back. All good here. Nice sunny winter's morning. But looking forward to speaking today.
I'm envious when you say sunny. I don't think I've seen the sun for weeks now. It has been the wettest autumn I can remember in the countries that I've been in for the last couple of months. But anyways, maybe Dublin is taking over as the sunny place in Europe, which would be unusual.
It's been pretty wet here as well, but no, the sun is shining this morning.
Good to hear. Anyways, an interesting lineup, I think, of topics, very kind of broad-based. We're going to tackle a few different things from macro to trend, CTA, and so on and so forth. Before we do that, not necessarily from what we're going to talk about today, but is there anything in particular that's been on your radar recently? It's been a while since you and I spoke.
Yeah, obviously it's been another interesting week in terms of bond moves this week, and we had the CPI number on earlier this week, which obviously shows the declining inflation trend. I was surprised at the magnitude of the reaction. When I checked the number and I saw the kind of the movement, I had to check it a few times to see had I missed something. But certainly, no doubt that the official numbers are showing that more evidence of the declining inflation trend. I mean, possibly because the most recent speech from Powell was maybe a touch on the hawkish side, so maybe people had positioned that way a little bit, and I don't know what the whisper number was for CPI, but certainly, even particularly from the FX perspective, I think the euro was up 2 big figures, which is a big move. Yields, obviously big moves, equities. So certainly I would say the number was consistent with the view of no move from the Fed in December, but certainly the size of the market moves were exaggerated. So I don't know if that was positioning coming into the event or the release or big stops or something like that. But certainly that was a surprise. But I mean, we have had some other reasons for optimism, I guess, outside of that with the Biden G meeting, which I guess is a step to in the right direction. But you might question how much substance there is or how much things will really change. But certainly an interesting week, and I was, as I say, that was kind of the most noteworthy aspect from my perspective.
Yeah, and I want to do something a little bit unusual because obviously, generally, we're not that concerned about numbers and fundamental information. But I have to say, when that number came out, I looked at my kind of Twitter feed, and there were suddenly a lot of people talking about, well, this number looks dodgy. So let me just dive into some of the things that I came across that I just found was interesting. Well, first of all, I would say timing. Timing of this number in itself was also a little bit interesting because, as you probably know, the week before, we pretty much had a failed 30-year auction. So that had also put a lot of pressure, and I think you're right in terms of positioning, played a role. I think people got scared the week before with the how the auction went. But then when I start sort of paying attention to what people are writing about these numbers, one guy was, well, not just one, but lots of people were focusing on the fact that and I'm just quoting from one of these tweets, according to the magic government CPI math, your health insurance went down 34% in the last year. Oh, and by the way, they give it only a 0.525% weight in the CPI basket. But what I can say is that here in Switzerland, it did not go down about 34%. In fact, it probably didn't go down at all. It probably rose, I would say. So that's kind of interesting. Also, there were people picking out the weights of how they do the CPI number, saying, well, actually, they weight fresh vegetables higher than that health insurance, meaning we should be spending more. We're spending more money on fresh vegetables than we are on health insurance. Not so sure. Also, we spend, apparently, according to the CPI basket, almost twice the amount on alcohol than we do on health insurance. So interesting stuff, I think, just in terms of how it all was put together. And when you look at a chart, someone was posting a chart of the US inflation health insurance year over year. And this goes back like 10, 20, 15 years. And you see it kind of bouncing plus minus, I would say 10%, but then suddenly it goes from up 30% a year ago or so, and now it's down 35%. So interesting to say the least. And I do think the timing of it a little bit suspicious, frankly, after that. You mentioned that sentiment has changed, and I saw one guy tweeting out that now futures show 0% chance of additional rate hikes, with cuts beginning in May of 2024. Prior to the CPI report, there was a 30% chance of at least one more hike ahead of us. So that's an interesting little thing as well. And of course, last week, Fed chairman said that he was not confident that they had done enough work. So, and then you had people like the Fed whisper guy, Nick Timiraso, or something like that, coming out saying, the big question will be how they're going to talk about their next policy move at the upcoming meeting. I also noticed one person that you may follow as well, Lisa Abramovich, and she was highlighting, of course, the fact that there is a massive amount of debt coming that needs to be rolled from the S&P 500 companies. We have more than 100 billion in debt coming due next year. And that, I think, used to be, last time was when the rate were around 2.8%. But of course, now refinancing is probably twice that. So that would be interesting. And then just talking about the market moves that you highlighted, I saw an article on Bloomberg talking about how this was kind of almost like a black swan, but I guess if the markets go up, it's like a white swan, because it was a very rare move when you look at the percentage move that we had on Wednesday. It says something like, in fact, in the nearly 8,000 instances of 10-day periods going back to 2002, only 5 other times has such a move as big or greater than the post-Halloween coincidence surge in stocks and bonds. Investors who dressed up as bears are very much regretting their costume choice.
Yeah.
So,
that's the thing that surprised me, because if you look at the, for sure the headline CPI had posted was it flat or down month on month, whatever it was, but obviously that's very energy related. But the core CPI, it's moderating, but still, if you look at the 3-6 month annualized versions, they're still kind of 3%, on most or above on most of the time horizon. So it's consistent with the falling inflation, the disinflation story, and it would give more comfort to the Fed. But yeah, to justify the kind of a too big figure move in the dollar and treasuries and equities, I was surprised in that. The one other thing I would say in the kind of falling inflation camp was interesting. A number of the retailers were out this week talking about deflationary pressures, which was interesting. I think it was Walmart or possibly Macy's. A couple of them had results, and they were talking about the consumer stepping back a bit and starting to see a bit more price pressure there. So, I think there's a lot of cross currents. There's obviously the shelter component, which people focus on as well, as saying that still hasn't fully caught up in terms of fully reflecting, and it won't. Obviously, it always does with a lag, what's happening on the ground in terms of new rent. So, yeah, I do think, hard to argue against the falling inflation trend and what the numbers are showing, but at the same time, it seemed to be an extreme reaction. But as I say, possibly but the fact that Powell had kind of tilted the market towards a slightly hawkish slant last week, which again, I was a little bit surprised on that one as well. But yeah, it would seem a fairly high chance of no move now in December, you'd have to say.
Yeah. I want to stay with the global macro a little bit longer. I want to dive into something that both you and I just sort of glimpsed over that Ray Dalio wrote. But before we do that, I just want to tie this week into kind of the trend world, the performance of this? Because clearly November is turning out to be perhaps the most, well, March was pretty difficult as well, but, a difficult month for trend followers, I think. And I think it's mostly really to do with what took place on Wednesday for the most part, especially those with sort of longer term horizon, maybe a little bit heavy in fixed income. Obviously, Katie and I spoke recently about the whole big short fixed income position and where we are on that. This is, of course, very relevant. But I would say from what I can tell, energies obviously didn't do great for trend followers and currencies. You touch on that as well. Now, we're about 6 weeks away from the year coming to an end, Alan, and clearly our industry will have welcomed some new investors on the back of a really strong 2022. And I'm wondering, from your perspective, obviously you sit on or have sat on the other side of the table to me for so many years, and how should investors think about their initial experience if they're relatively new to the space? They're coming up probably for some year-end investment committee meetings. How would you help them frame this year's performance, where we are, also in relation to what happened last year?
Yeah, I think it's a tough. Okay, maybe tough is it too harsh? The stock trend index down 3% on the year, so it's a negative year. You would have to. We have been highlighting that we're getting more interest income in trend and managed futures funds, so it's actually worse, than that. If you think about that, if this was back in the era of zero rates, we'd be in a kind of a -6 year or something. So it's actually tough. I was looking at the SocGen have a report that they send out of all of a vast majority of the CTAs, and they have a data on about 200 CTAs in the CTA and kind of quant macro space, and about 100 of them are up, about 100 of them are down. So it's that kind of year. In aggregate, the industry, based on the indices, is down, but there are managers up, there are managers down. For strategies that manage futures, managers run with the kind of sharp that they are, you should expect some flat years, some negative years. It's not, nothing statistically significant about it. It's part of the normal ups and downs. It's just a reminder that it can be a tough strategy to hold when other things are doing well. When we did the series talking to all the top CTAs, this was something that came out. The trend following managed futures can be tough to hold. And after a period of 2 or 3 years where it's doing very well, you say, well, what's that? What's difficult about holding CTAs? It just delivered the trend index just delivered 27% in a year when the equities market was down. So what's tough about that? And then you get March, and then you get what we've had in November. And it is a reminder, particularly in a year when equities are doing well and your 60-40 is going to have done okay, driven more by the equity side, and a diversified liquid alts portfolio is probably around flat. So people will immediately be saying, no, do we really need this? So I think it's all about, one, keeping a long-term perspective, two, reminding yourself, why is it in the portfolio? And three, another investor made a good point that, zero correlation, doesn't necessarily mean negative correlation. It just means zero correlation, So, it's just a year where managed futures and trend following hasn't done particularly well. But, I don't think there's anything to read into that.
No, exactly. And I certainly want to stress the fact that you say, the trend index is down about 3% for the year. But let's not forget it was up 27% last year, and it was up 9% the year before, 6.25% the year before, and 9% the year before. So actually, of course, in our completely biased point of view, this is very normal. Before we head back to the global macro space, let me just say that my trend barometer that you can find on the website finished yesterday at 41, so completely neutral, where it's been staying in neutral for most part of this year. And I think this is also reflected in the performance that we just discussed. Performance-wise, beta 50 down 2% for the month, but still up 42 basis points for the year, which is a little bit unusual compared to the other indices. SocGen CT Index down 3 for the month, down 3 for the year. Trend we talked about, down 4.25 for the month, down 3.25 for the year. Short-term traders index down 1.3% for the month, down 2.6% for the year. And then compared that to obviously incredibly strong equity performance this month, the MSCI World up 7.38% so far, up 14. So half the return so far this year coming in November. World Government Bond Index for a change, a really strong month, 2.29% up. And the S&P total return up 7.6%, up 19% for the year. All right, I just wanted to head back before we dive into some of the other topics. You and I came across one of Ray Dalio's latest articles. Of course, he's been kind of very vocal in the last few years about kind of the dramatic change he sees. And I think he's been saying, by the way, that 5 years from now, we're not going to be able to recognize the world we live in and so on and so forth. He had a little bit of an article that came out because obviously focusing on the relationship with China, it's very important. And now for the first time in 6 years, I think she came and met in person President Biden at the Apex meeting. And actually Ray Dalio came out with an article saying, well, maybe the actual hot war between the countries, the chance of that has come down, but there's another war that's going to be intensifying in his view over the next few years. Can you talk a little bit about what he has in mind and any thoughts of your own that?
Sure. Yeah. You sent it on to me. I had to read through it. What he's saying is basically the US and China kind of went maybe not to the brink in terms of an actual physical war, but things were heading in that direction of heightened risk of an actual conflict in relation to Taiwan and the Chinese military build up around Taiwan. But in the last couple of months, things have warmed up, in terms of their relationship as opposed to cooling further. Obviously, Janet Yellen had been there. There had been a couple of officials there, and things have kind of culminated in this meeting between Biden and Xi, which seems to have been, signaling a thawing of relations, and lots of positive talk about from Xi about the globe being big enough for two big superpowers to grow and no need for a conflict. So I think that all of that makes sense. And then Ray Dalio's point has just been, yes, okay, physical conflict maybe not on the horizon immediately, but that doesn't mean things are all rosy between the US and China, and that obviously you still have these two superpowers vying for, global influence, global dominance, and that's going to continue, and that the war will be more in the background, technological, and that the strategy will be more like, as he says, hide your strengths, bide your time. It's an old Chinese proverb, and is kind of Deng Xiaoping. That was his philosophy of build up your strength, but don't necessarily promote it. So I think all of that makes sense. I mean, just because we've had a meeting between Xi and Biden, all of those kind of structural concerns about national security don't go away. Obviously, the US is still trying to build its own. They're both still trying to build their own chips capability, and trying to limit each other's access to. Well, certainly in the US's case, limit their access to certain key technologies in relation to chips, and then obviously China has rare earths that the US would like to have. So this ongoing battle is going to continue, but it's just not going to be an overt battle. And I mean, I think that makes sense. I don't know if it's anything too dramatic. I think obviously there's a little bit of optimism this week on the back of it, but equally, Xi spoke at a business leaders dinner after his summit with Biden, and the feedback coming out of that was interesting. That there was it was described as a lot of propaganda, but no real positive talk about opening up barriers around trade or investment or anything like that. Obviously, US business leaders would love if US-Chinese relations thawed and grew, because the likes of Apple, BlackRock, all of these huge firms have a massive exposures to China, and their whole processes massively embedded in the Chinese economy, at least in relation to Apple. So obviously you would expect the business leaders to be sympathetic to China and upbeat, but it doesn't seem to be a whole lot of substance. So yeah, it wouldn't be surprising if we see the shifting sands move back towards greater conflict at some point in the future. But for now, things are looking a bit rosier.
Yeah, no, I think that's a great summary. What he also says, which I think is also kind of interesting, is, of course, that even at times when two, say, superpowers in this case, realize that they're better off working together than fighting each other, they still might end up fighting each other because they are worried that one will beat the other if they wait too long. What I find interesting about this, well, there's two things. Obviously, I'm a little bit skeptical about what people say because it's, action speaks louder than words, I think. And there hasn't been a lot of action that kind of confirms these this new love affair between Biden and Xi. But it's also the economic side of things, where what Dalio actually is saying is that you should spend your time to really build on your strength and get your house in order. But if I look economically, I don't know much about Chinese economics, but from what I can read, it's not in great shape. I know a little bit more about US economics, and that for sure doesn't look like it's in great shape. So, it is an interesting time, and who knows? But you're right. For this week, probably a little bit of cooling off the tension between the countries. Other things cooled off, because I think you're going to talk about a few other macro things that you found, such as the savings rate, for example.
Yeah, I just wanted to touch on, we normally to spend a few minutes talking about kind of the big picture macro view, but rather than going into all of that and what we've seen in the data recently, there was just kind of two or three data points / observations that I thought were interesting recently that are kind of important, not so much in the day-to-day, week-to-week, but are important in the big picture. First one is the recent release of the US consumption and income data, which includes the savings rate. And it showed that the US savings rate was down to 3.4%, which is low. It was down as low as 2.7% in 2022, so last year. But to put that in context, like on average since 1990, the savings rate is about 6% in the US. So the US savings rate is generally low. In Europe, the savings rates are all above 10%. So the US historically has low levels, but it is unusually low at the moment. And we have seen this in the past. If you go back to kind of 2005, 6, 7, it was averaging around a similarly low kind of 2 to 3% level. But at the time, people worried about, is this sustainable? So again, it does raise the question: are US consumers spending too much? Why is it the case? So it could be linked to the excess. So they have a stock of excess savings that they built up during the pandemic, and that allows them to spend more out of their current income. So that's what the savings rate captures than they have done historically. It could be, related to demographics and retirees. Or it could be just a temporary thing that people got used to spending a lot of cash in the pandemic, and now have continued, as we came out of the pandemic, and have continued it and are running up credit card debt, etc. So it's a warning sign, I think, but it's not something that you'll say is going to impact this week or next week. As I say, if you look at the experience back between 2005 and 7, the savings rate did stay low for a prolonged time, but then eventually snapped back. So I think it is quite something to monitor. Is this sustainable? Because if you think about it, if the savings rate went back from 3% to 6%, that's 3% of GDP. That would be quite a big hit to the economy. And you almost certainly would see, obviously it wouldn't happen immediately, but if it happened over time, you'd probably see a recession as part of that process. So that's kind of something on the negative side to be a little bit concerned about. On the plus side, we had productivity numbers recently. And productivity numbers are really important for the long-term outlook for the economy, but tend not to get that much attention in the short term because the numbers are very volatile. And the third quarter non-farm productivity was up at a 4.7% annual rate in the US. It's very strong numbers, the fastest pace since the pandemic, and those numbers were inflated because of what went on in the pandemic. If you look at the long-term trend in productivity, it's been very poor in the last decade. Actually, if you look at the 10 years to 2020, productivity in the US just grew at 1.1%, which was very low by historic standards. Whereas if you look at the 10 years between 1995 and 2005, so that was the era, the productivity boom, Greenspan, the new paradigm, all of that. Productivity grew by 3.1%. So a 2 percentage point differential is enormous, because long-term economic growth is basically driven by growth in the labor force and productivity. So if your productivity is growing at 3%, your labor force might be growing at 1%. So that's why people thought long-term growth could be maybe at 4%, back around 2000. Whereas now people think, and economists think, long-term growth is like 1.5% to 2%. So why do I mention this? Well, there is some optimism that things are turning. As I said, the most recent number was stronger. There is a sense that maybe what happened during the pandemic with hiring and firing, companies were hoarding labor for a while. So they had more people on the books maybe than they needed, because they were worried about being able to get more labor. And that meant that the output for the amount of labor that they had is falling. So productivity declined for that reason. And maybe working from home and all of those disruptions impacted productivity. So there are reasons to think that might unwind. And then obviously the big hope for productivity is around AI and automation and robotics and all of that. So if we did see a boost from productivity, so basically if this recent trend that we're seeing of better numbers, if that continued, that would actually be very positive. Why? Because higher productivity would mean higher economic growth. It means wage growth can be higher without fueling inflation. And it would mean debt would be more sustainable, because, everybody's looking at the debt situation and they look at the interest rate, but it's all about the interest rate in the context of the economic growth rate. It's basically the difference between rate R minus G. It's what economists talk about. So I think some good news there. I don't know if the market is partially responding to that. I mean, one productivity number, they're so volatile, it wouldn't make sense to do so. But certainly it is something I would say worth monitoring going forward on a kind of over the next number of years, next number of quarters for sure, because if productivity was to pick up, that could be part of the story around maybe a more optimistic outlook. And that takes me to the final observation. The Economist magazine had an article out, not this week, last week I think it was. Can't remember the title, but it was basically saying that the expansion can't last, which is kind of talking about what I'm saying around the savings rate and saying, okay, productivity has been low, but slightly picked up, but too early to draw any conclusions. We've had monetary tightening, fiscal policy can't continue at the same rate. All of the things that I would have said myself, to be honest. But when I read it in The Economist, it makes me worried. Why? Because magazines like The Economist are great for kind of general information and insight on the economy, but tend to be terrible kind of forecasters of markets and the economy. So there are a number of people in the Twitter world who kind of highlighted the poor record, of these publications. That some of the classics are the death of equities from Business Week in 1979, just before a massive bull run, or The Economist had a piece drowning in oil in 1999 when oil prices were at the lows. Even last year, they had a piece to trouble with sticky inflation, and obviously inflation has come down. So when I read that from The Economist, you do start to worry that maybe we're too pessimistic. I mean, I would have been in the camp of saying, you have to be concerned about that fiscal policy won't be as stimulative next year, and we haven't seen the full impact of monetary tightening. But maybe that's too much of a consensus view. On the plus side, one final piece within all of this, Goldman Sachs have their macro outlook out, and they are more upbeat looking into 2024. Their view is basically the hard part is done. The outlook is rosy. So that's interesting as well. And I actually went back and I had saved last year's version of Goldman's, because I was thinking, well, how good have they been? And they were actually pretty good last year, to give them credit. They were more upbeat on the outlook than everybody else. So maybe something to keep in mind. So yeah, I mean, personally, still cautious, but it does make me pause for thought when I see it in the mainstream media like The Economist magazine.
And another chart that I came across in the FinTwit space that gives a little bit of a pause for thought, and also is to do with I would say optimism, I guess you could say, because I found this chart from Bank of America. They did a survey of fund managers, and found that they are the most overweight in bonds since March of 2009. And then they go into say, well, probably shouldn't read too much into it. And to cut a long story short, March 2009 wasn't a great time to be bullish bonds because they actually sold off quite sharply after that. So not saying that this will happen again, but investors are maybe turning bullish on bonds. And perhaps there is still a little bit more room to the downside before it all turns, which of course it will at some point. All right, Alan, enough of all this global macro mumbo jumbo. People are here to talk about hardcore, systematic CTA trend stuff. And you found some great articles and papers that we need to dive into. The first one is from our friends over in Paris, CFM. They had a paper. So I will pass it over to you. And I think it's a point that I seem to remember Philip brought up in our conversation when we did it. Okay, all right.
No, that's cool. Right. I mean, it's actually not a recent paper. It's back in 2017, but the context it came up in a discussion I've been having with a client recently around trend and non-trend and the benefit of non-trend strategies. And when we interviewed Philip Seeger from CFM in part of the SocGen series, he made a point that they had done a study saying, if you look at the SocGen CTA index, trend following explains all of their returns and non-trend basically had contributed nothing. So I wanted to kind of go back and say, well, because I've heard that now being kind of repeated by other managers and people maybe using that in certain ways. So I wanted to get a better sense on exactly what they said and is that a reasonable thing to take away from their study? So they had this was done in 2017, around a time when there was a lot of focus on CTAs saying they're all the same, it's all commoditized. So it's kind of in that period, and that was kind of the context. So they regressed a very simple trend model on the returns of the SocGen CTA index. They looked at 2 months, 6 months, and 12-month type timeframes using exponential moving average model. And they found that the 6-month model was the best fit, and they found that this was able to generate a 0.9 Sharp versus the Sharp of the SocGen CTA of 0.4. Now their replicator obviously didn't include any trading costs or fees, and they were able to say, well, if you take out 4%, which I'm not sure if that's supposed to be reflective of all of that they were able to match the performance of the SocGen CTA index purely based on this trend model. So, I mean, just to quote a couple of bits, they said the aggregate of the CTA industry is well described by trend following, fair enough, and the performance of the remaining unexplained return stream is flat. So that was their takeaway. Therefore, CTAs only offer exposure to trend following, with the contribution from non-trend being zero. Obviously, some firms can outperform and others will underperform, but in aggregate, that's what they were saying. So that made me think, based on my own experience allocating to managers, seeing the performance data, I would say that's not my experience. I would certainly have seen instances of non-trend strategies being additive for individual CTAs and in the aggregate. And I went back and looked at even if you look at the performance of the SocGen CTA index versus the SocGen trend index, historically the SocGen CTA index has a higher Sharp ratio. It's a lower vol index. But if you levered it up to the same vol of the SocGen trend, you do get a higher return. So that is suggesting that non-trend is contributing something to the overall performance. I think there are methodological issues here that you have to keep in mind, that if you look at something like the SocGen CTA index, it's 20 managers, they're all equally weighted. So it's basically 5% dollar allocation to all 20. So if you have a trend following manager that's say a 20 vol manager, and if you had a macro manager, say at 5 vol, and 5 might be low, but just to highlight the point, the risk contribution from the trend is going to be four times the macro manager. So in general, I would say trend followers run at higher vol than what I see from, say, quant macro or non-trend managers. So it's not necessarily representative in that sense. It's an index that is more heavily weighted to trend following anyway. So to say that trend following that you get a lot of trend following from CTAs, that's hardly news. That we all know that. I suppose the debatable point is whether the non-trend part adds something or not. I would say it does. You can see that in the performance of managers. I mean, the curious thing when you think about it is, and Philip talked about this, like CFM run about 9 billion, 8 billion of it is in non-trend strategies anyway. So they're not saying that non-trend strategies don't work. They're just saying, they seem to be saying in the paper, CTAs are not particularly good at doing it. That's my takeaway. I mean, the paper can be used, as I say, in different ways, and it's kind of interesting. Some managers have taken that observation and saying, all you get from CTAs is trend, and non-trend doesn't work. Others have taken it maybe and used it as support for replication. If you can do the CTA and take out the fees, you can do even better. So that's another way you could take that information and use it slightly differently. Yeah. So and then the final way was, I back at the time, I suppose a lot of people used it to say, hey, look, a 6-month exponential moving average can fully replicate the SocGen CTA. So why would you pay for more sophisticated trend? So I think it's interesting how one piece of research, which may have some methodological questions, can still be used because it generates a kind of a sticker headline, and then still used by different managers to support different positions. But as I say, my perspective on it was interesting study, but this didn't necessarily prove the point that they were making, and certainly didn't seem consistent with their own business. If you think about it, that obviously non-trend, and they've been very successful, we have to say. So it answered, if somebody asked me, are there opportunities in the non-trend space? Of course there are. But you have to be skilled at exploiting them.
Yeah, there's quite a few takeaways from my side when I hear you talk about that. First of all, I think there's one thing that we also have to mention, and that is some managers that are referred to as non-trend. Some of the managers we actually interviewed in our series actually have a fair allocation of trend inside their program, even though they're classified as, say, a short-term manager, but actually, part of their risk budget goes to medium to long-term trend following. So that makes it even more difficult to actually understand completely what's going on. Yeah, I mean, I think if you're a trend follower, you probably would need to be able to show that you've outperformed the trend following index to show that you, add value. Otherwise, of course, you could make the argument, well, why not just buy the index? Which brings up one thing that actually, Alan, I don't know if I thought I heard a while back that there was talks about the index becoming investable. Have you come across that?
No, I haven't. Not for the SocGen. The one that was being talked about was the HFRI hedge fund index. I think there was talk that I think they were Aberdeen Asset Management were developing a product.
I think that is live. I think that is a live product
that invests kind of across the hedge fund universe, but not for the SocGen trend or SocGen.
No, that's fair enough. It's only because I noticed that they've changed their performance, the way you get the performance numbers for the index. It's become much better now, actually, because now you get the monthly returns instead of just the daily returns, and you have to figure out what the month turned out when you download it from their website. And it talks about a NAV. So I'm thinking, well, maybe they're toying with a real live version of this. Anyway, that's for a different discussion. I'm sure our friends over at SG will tell us if there's something we need to concern ourselves about. But anyways, I mean, of course, a big obsession from the allocator world is justifying their business by saying, well, you can't just buy a trend follow, you need to add a few extra things. And of course, for some firms out there, that has worked very well. So I'm sure that is true. But I would also buy into the argument saying, well, if you have the patience and I don't know if that was the question also in the paper, but I don't know if these fully diversified or more diversified products actually do better. They can maybe create a smoother return path, so to speak, smoother return stream. But do they do better than a few really good long-term, well-established trend followers put together? I don't know. I haven't done the
Well, I think one of the challenges with this is once you move out of trend following into non-trend, there's a huge range of strategies. Obviously you have futures-based strategies, you have within equities, you've got discretionary, systematic, and the benefit of we have a trend following is we have these indices that show actual live performance going back at least a couple of decades with daily data, back to the 1980s, with the Berkeley Hedge, the Berkeley CTA Index, and back to 1990 with the P-Top 50. So we can show with certainty that a group, like with a strategy that, okay, there's different ways of doing trend, but that broad approach is proven over that period of time. Whereas when you get into the non-trend, it becomes more manager specific. It's harder to create these indices. So I think it's harder to prove that it works. You're probably, maybe it's more the case that, it probably is the case, that manager selection is more important in that space because, you can't say everybody is doing things slightly differently. But of course, to say that trend is the only thing that is valid and can generate returns over the long term in the futures trading or diversified macro area, no. I don't think that you could stand over that.
That would be a little bit of a stretch.
Well, yeah, it's a bit of a stretch. Look at the many successful firms who are doing things. They are doing CFM, for example. They do trend, but they do other things as well. So I that's what was my point. I think this study has been somewhat hijacked in how it's been used in some instances.
And kind of that actually brings up one other thing that just hearing you talking about this, and that is if I look at the evolution of our industry compared to when I started out some 30 plus years ago, I think the big change is that a lot of the people who were our peers back then have morphed into these, I wouldn't call them multi-strat firms because that's a different strategy, right?
Yeah.
But it's firms that offer multiple strategies.
Yes.
And so there really aren't that many pure single-focused trend followers out there left in this industry. And that I find interesting, frankly. But,
No, I'd agree with that. No, for sure. There are very few, there are a handful, I would say, of managers who just focus on trend following at the exclusion of everything else. Yeah, for sure.
Yeah. All right. We're going to jump back a little bit later in a few minutes into another paper from some of our CTA friends. But before that, I think we're going to jump into a paper from a well-known firm called JP Morgan because you came across their long-term capital markets paper and what they're, I guess, advising their clients to do. And I think the big sort of what I took away from it, I'd love for you to expand is it, and that is, and it kind of goes back to some of the things we've talked about before, and that is, what are we going to do with this 60-40 portfolio? Is it still valid, or has things changed? What did you take away from this paper?
No, that's exactly it. And the reason I bring it up is twofold. It's interesting to have a sense of what people are thinking in terms of expectations for returns around equities and bonds and all of that. But a big part of this paper is talking about the new worlds that we live in and diversification and enhancing the 60-40. And obviously trend is relevant. So just in terms of their kind of capital market assumptions in the first place, they're looking at US equities delivering 7% over the long term. European equities more optimistic, 9.3%. They see dollar cash averaging 2.9% over time. And to see 10-year bonds generating returns of 4.6%. So a 60-40 portfolio in dollars, and this is using global equities and US bonds, therefore forecasting 7%. A US focused 60-40, so US equities and US bonds would be about 6%. So it's okay, but actually that number would have been closer to 10% in the 10 years to the end of 2019. So in that decade. So 60-40 looks okay, but not fantastic. And they do make the very important point that we have been emphasizing that, bonds can still be a diversifier to a growth shock, but not necessarily to all shocks, particularly what we saw last year, which was more of an inflation shock. And that's because a recognition that the correlation between bonds and equities is going to be less stable going forward. So I think that was all made sense and, agreed with all that. When they followed on from that, they do give some forecasts on the alternative space. And I mean, they mentioned, return expectations for global macro of 3.6% down from 4.1% last year, which surprised me a little bit because obviously with a higher interest rates, you would expect global macro funds, which tend to hold a decent amount of cash like CTAs, you would expect the outlook to be looking better. But anyway, that was just one bugbear. They as you go through the reports, they have a lot of separate articles, and then they get to one where they're talking about how to develop a smarter portfolio to mitigate shocks in a less predictable world. And so this is basically how to make your 60-40 portfolio more robust. And they talk about a number of different sources of diversification. The first one they call risk premia, and they actually include trend following within risk premia, which I know will annoy some of us and some of our listeners. I guess the idea is a trend picks up on a behavioural source of risk premia. So good to see that actually trend following is in there, because very often with these reports, there's absolutely no mention of things like trend following. So I was encouraged to see that. They do also include things like active management, and they reference global tactical asset allocation, so kind of shifting, which is interesting because if you think about it, trend following is a form of global tactical asset allocation, which we're going to talk about with the Quantica paper. They also include FX as a source of return. So, obviously a lot of these types of investors might use currency overlay, but they're saying, don't forget, you could take active FX risk. But again, you can do that with specialist FX managers or get it via a diversified manager like a CTA. And then they say, other sources of diversification from thematic exposure. So this is fair enough. I mean, in terms of maybe having exposure to energy would help you in a year like last year. And then separately, they have alternatives, which include hedge funds and alternative credit and real estate. So interesting, CTAs not included in that side, but included in the risk premium side. So I think all of that I thought was very encouraging in terms of this narrative around the need for more robust portfolios, and encouraging from the perspective of CTAs and trend following being referenced within that. They then did outline kind of a new enhanced portfolio, but actually when you looked at it, it didn't look that different to what you would typically see. Bonds 36%, with a heavy weighting to investment grade corporates. Equities were about 41%, real assets 10%, private 7%. Hedge funds were only 1%. The numbers didn't add up to 100%. So I'm not sure if they missed something or not. But still, there was no mention of a reasonable size allocation to CTAs or managed futures. Now, this enhanced portfolio did outperform the typical 60-40, and then they did redo it using a fully liquid version, so taking out some of the real assets. But they didn't kind of give the breakdown for that, and then that also did better. So overall, I would say philosophically, good, and they were on a kind of. I like the way they were thinking in terms of describing the world, the more volatile macro backdrop, the less stable correlations between bonds and equities. We're probably going to be in a higher return world in terms of interest rates, etc. And they are identifying some interesting strategies there in terms of FX, trend following, etc. But still, they also mentioned within there that, important not just to do mean variance optimization, but more robust optimizations using simulations, Monte Carlo simulations. So I'm amazed, having done those Monte Carlo simulations, that managed futures and trend following didn't pop up at a higher allocation. So, as I say, yeah, interesting, but still looks very much undiversified to my eye when I looked at it. Particularly if you look at it from the perspective of, they had, say, 10% in treasuries, 20% in investment grade bonds, 3% in high yield, 3% emerging market debt. As we've seen before, things like investment grade bonds and credit they're not great. They have an element of fixed income, and then they had an element of equity exposure. So you're getting a hybrid of those two exposures. You're not really diversifying either bonds or equities that much with things like credit or emerging market bonds. And similarly with real assets, they are heavily related to the economic cycle. So if you have an economic downturn, they won't do that well. So there's a whole sleeve of tactical trading strategies that gives a very different return profile that they're not really aggressively allocating to. So positive in one sense, but a bit frustrating in another sense was my takeaway.
Well, just like we talked about with Xi and Biden, I mean, often action speaks louder than words. So, I mean, you can talk about all these things, but if you still end up with a 1% allocation, it's probably not going to make a big difference. One thing that I'm also a little bit surprised about when you see these and people end up with something that looks very similar to the 60-40 is just the fact that they kind of ignore that maybe correlations between stocks and bonds can actually remain positive now that we have inflation, because that's at least what the historical data shows, that once you have 3% or above inflation, most of the time these two asset classes are positively correlated. So you get no diversification benefit in that sense. So it's interesting that they ignore this. But anyways, that's their view. Let's jump to another view, which is from Quantica. And that actually goes to your to what you mentioned, trend versus global tactical asset allocation.
That's right. Yeah. So I thought this was a very interesting paper. So it's called Trend Following Through the Prism of Tactical Asset Allocation. And it's very much a niche follow-up to what we've been talking about, because they take the perspective of a long-only investor, a typical, I suppose, it could be a wealth manager, asset allocator, and say if you had these 16 ETFs that they identify across different asset class, for example, treasuries, investment grade bonds, high yield bonds, emerging market debt, municipals, and then alongside equities, real estate, commodities, and gold. And if you were to go with a typical kind of risk asset allocation that you would see. So what they're trying to do here is they say, okay, let's take a kind of a typical asset allocation, that kind of a strategic asset allocation where an investor would just kind of pick their strategic asset allocation and rebalance monthly. And then let's look at that and say, well, say if we were to apply trend following to that, not trend following in the sense of not going short and not using any leverage, just modulating the exposure to those 16 ETFs based on the strength of the trend in those markets. So kind of, you might call it long only trend following. And does that create value? And what they found that it does. So if you applied their kind of standard trend following model to those 16 markets, and they figure out how to equate the risk to a similar level, and the average notional exposures were similar, although not exactly, because obviously there's going to be two periods where if the trend's down, you're going to go into cash and you're going to have no exposure, little exposure to these assets. Interesting, what I found was the trend following on the ETFs did better, slightly better, I think it was about 5% versus 4.8%, but at a much lower volatility. So about 7.5% versus 11%. So obviously, why is that? Because obviously when equities go into a serious downtrend, you go into cash, and you might have upgraded your fixed income to an extent, but you're not losing leverage, so you wouldn't go massively overweight, and you would benefit in those types of situations. So you get better performance, lower vol, and more consistent volatility as well than just a passive strategic asset allocation approach. So the second thing that they did then was to say, well, okay, that's fine, but what about if we eliminated the constraint around leverage? So if you think about it, this type of investor has kind of three constraints: no leverage, no short positions, and only trading those markets. So what they do is then gradually relax each of those restraints. So by kind of taking away the leveraging constraint, you're kind of moving more into like a risk parity type of model. So if you think about what's risk parity, it's saying, there's a return from bonds and equities and other sources, commodities as well. But in most portfolios, they're not sized properly because the volatility is greater in equity. So if you adjust for the leverage, you can add value from that. And what they found is, that did add value as well. The third thing then is they added short positions. Now, actually, when they did this within the 16 ETF portfolio, the performance didn't improve that much, or it was about the same, but it had better risk. It was a more robust portfolio in terms of bear markets, that they have more consistent return profile. And then the final thing they said was, well, okay, let's just not do the 10 following on the 16 ETFs, but let's broaden it out and allow the leverage, allow the short positions, but doing it on whatever it is, 100 markets or a typical kind of trend following universe. And then you do see the returns jump up again by quite a lot as well. And I thought that was interesting. So if you think I think it's an interesting and a valuable paper. People think about CTAs and trend following, and it's all about the signal, but it's not just about the signal. So the value, the benefit of it in a portfolio is coming from the signal. So yes, there is momentum in markets. If you modulate your position based on that, you can add value. But also it's about risk sizing and sizing your exposures appropriately. Okay, it's related to volatility. People might have how you measure vol or how you measure risk, but having some measure of risk and equalizing for that does add value. And then diversification and getting access to different return drivers had a big contribution. And if you think about it, it comes back to my point, like in their 16 ETF portfolio, it's all treasuries, municipal bonds, corporates, emerging market debt, real estate, commodities. As I say, you kind of got two things. You've kind of got assets that do well when growth is strong, or assets that do well when growth is poor, But you kind of got two dimensions there. If you start adding in commodities, currencies, short-term interest rates, you're getting much more idiosyncratic return profiles, and that's where you're getting a lot of the benefit from trend following. You see the big jump up in the overall return. So I thought it was a very good way of kind of decomposing the benefit of trend following into three constituent parts: that of the signal, the risk sizing, and the diversification from a lot of markets. And I think it's interesting. Maybe it's a good way. It might be a helpful way of showing to kind of more traditional asset allocators the benefit. And obviously, they don't have to run trend following, or they don't have to even try and do that on their multi-asset portfolio. But if you add a trend following fund to a 60-40 portfolio, you're achieving the same thing if you think about it. So if you start with a 60-40 passive portfolio, add a trend following allocation. The trend following manager is going to be trading bonds and equities as well, but also commodities and currencies, and it's going to be risk sizing, and it's going to be long short. So what have you got now? You've now got a dynamic multi-asset fund, that goes much, obviously where the overall exposures shift around a lot more, and you've got you're more diversified. So you don't actually have to go and run trend following. All you have to do is add that into your exposure, your existing portfolio, and you get that more dynamism. So I think that's the important point to think about when kind of positioning, I guess, these to more traditional allocators.
Yeah, no, I completely agree. Thanks for this sort of a walkthrough. I agree. I mean, I like all their quarterly insight papers. They do a great job, and I think you're absolutely right. This is a fun, subtle way of actually highlighting the benefits, but speaking in a language that maybe a lot of these traditional investors might relate to. Now, the last point we will just talk about before we wrap up today is something where we probably both felt that this is most likely above our pay grade. And then I said to you, well, that hasn't stopped us before. So you came across this interesting article from the FT, could be from this morning or yesterday. And we're at an interesting point in time, not saying that there's going to be a crisis of some sort. We've had plenty of that recently. But there are things happening outside our world, but in the alternative investments worlds where you sometimes think, well, it's a little bit interesting. We've had private equity having kind of difficulties offloading some of their inventory, and then they're being sold to other funds that they create, and where you all think that's a little bit weird. And then you came across this one. The headline was Blackstone borrows to boost lending power of $52 billion credit fund. And what it's about, it says Blackstone is planning to borrow hundreds of millions of dollars to give its flagship private credit fund added investment power as the asset manager taps a new source of leverage that it and rivals aim to increasingly exploit in the years to come. The private equity behemoth is in the final stages of raising just under $400 million through a so-called collateralized loan obligation secured by the very loans held by its $52 billion Blackstone private credit fund known as BCRED, according to documents obtained by the Financial Times. Now, this is way above my pay grade, Alan, but I could read the chart that is in the article where it shows that Bank of America expects private credit CLO insurance to jump in 2024 to a higher level than what we've seen in the last 10 years, maybe even a record level. What did you take away from this?
Yeah, no, it was funny. I came across it in the FT's unhedged morning newsletter, and they said, right at the end of the newsletter, they said, our head hurt from trying to make sense of this article. So I could feel their pain after I read it. Yeah, I mean, it's interesting that, I mean, basically they're issuing CLOs to get more funding for their private credit fund. Now, the interesting thing about these private credit funds that I thought about in the first place is they actually have credit lines to the banks, which seems a bit unusual, because the whole point about these funds, private credit growing in the first place, was that they were going to displace the bank lending, but actually they had been borrowing from banks to issue their own loans. But it seems like banks are stepping back a bit in terms of their lending to some of these funds. So now they're looking for alternative sources of leverage and returns. So now they're issuing CLOs. So it's kind of funny then, well, where would you invest? And would you invest in the CLO, or would you invest in B credit itself, the BlackRock credit? And I guess with the CLOs, you can pick exactly which tranche you want, whether you want the highest tranche in terms of credit rating or not. So maybe there is some reason to there. But then Blackstone are holding the B Cred fund is going to hold the equity of the CLO. I didn't realize there is equity, but I looked it up, and the CLOs all have different tranches, and the lowest tranche is called the equity tranche. So I guess it's the bit that is, if everybody else gets paid out, if there's anything left, that you hold it. So they said this is kind of to avoid any conflict. But I mean, at a simple level, when we hear about CLOs and credit and big amounts, we all get worried. So we're probably not equipped to critique it in any sophisticated way, but it does seem like more leverage being thrown on the space. And I suppose the thing that I find interesting is everybody's saying that, well, now this kind of private credit is good because it means it's not systemic. It's not going to bring down the banks if you get a problem with some of these loans. But presumably these big private credit funds, if they run into problems, particularly if they run into problems under CLOs, would that mean they'd have to start pulling back on their lending? So you might still get those systemic impacts that we thought we wouldn't see. So that was the only thought I had. Certainly worth monitoring, and I'd say we'll probably hear more about this going forward, and hopefully we'll have more informed comments to make about them next time we read about them.
Yeah, no, absolutely. It's probably best to leave it there. I guess my uninformed reaction was that when you hear about, I'm going to add extra leverage because there are some great opportunities, it sounds like you're already underwater in some of your positions, and now you just want to find a way to buy more, doubling down here. But I could be completely wrong, of course, and this could be the greatest thing since sliced bread, for all I know. Anyways, this was fun, Alan. Thank you so much for your thorough groundwork for our conversation today. If you like these conversations and you want to help us grow the show, please go and leave a rating and review. We need them coming in on a continuous basis because that's what the algos like to see. If you don't know how to do it, you can actually go to toptradersunplugged.com/review, and there's a little guide as to how you can help us with that. Of course, if you have any questions for upcoming episodes, you can send it to info@toptradersunplugged.com, and we'll do our best to address those. Next week, I'm joined by Mark. He's back. And so if you have some questions for him to tackle, by all means, email them over, and we'll do our very best to give you an informed answer on that. From Alan and me, thank you ever so much for listening. We look forward to being back with you next week. And in the meantime, as usual, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.